Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to Through the Noise podcast. Today is the 24th of May. 24 is also the number of times S&P 500 closed at record highs this year. The latest one came on Wednesday when S&P 500 closed 0.3% higher at 5321.41. Are we going to see this number rise heading into the rest of the year? Our guest this week will help to answer that question and more. He's none other than Manpreet Gill, our Chief Investment Officer for Africa, Middle East and Europe. Welcome to the podcast, Manpreet. So, are we going to see more record highs for the rest of the year? Of course, that will require the equity market rally to extend.
Hi, John. Thanks for having me on. Yes, we do believe that the equity market rally can extend, and that means we'll most probably see more record highs this year. Now, to understand a little bit more about where we're coming from, the macro context is important here, particularly this month. Now, as many of you might know, we've had several higher than expected U.S. inflation readings in recent months, and markets, of course, therefore collectively heaved a sigh of relief that the latest U.S. CPI inflation reading was finally slightly below expectations. Now, that's important for markets because April's pullback in U.S. stocks was quite correlated with the prior jump in inflation worries, which of course in turn led to a pushback of Fed rate cut expectations and the rise in bond yields that we experienced. Now, this relatively high correlation with the macro data extended into May, with the rebound in equities and bonds, of course, closely correlating with that fall in U.S. inflation surprises. So this, of course, was consistent with our own expectations that the pullback in equities and bonds in April was likely to be temporary. So overall, where that leaves us is that, yes, we do see room for the equity and bond market rally to extend. If you think about it, several indicators of the housing market, especially falling market rental costs, do suggest it's reasonable to expect the official inflation rate to continue grinding gradually lower. That, in turn, of course, should help the market's inflation expectations and therefore bond yields to ease, and in our view, the Fed to start cutting rates in the second half of the year. The euro area, of course, is an example of an area where inflation actually is even less of a challenge. So we, of course, expect the ECB to start cutting rates a little bit sooner than the Fed in June. So when you put all of this together, we do believe the policy backdrop remains a pretty favorable one for global equities and indeed for bonds as well.
Okay, so it sounds like chase the equity rally, but where within the equity market should we chase?
So I think our regional preferences here are important, right? First place I'd look, of course, still the US, where we're overweight as a region. And here there are a few different moving parts, right? Our short-term technical models, which takes a 1 to 3 month view, that's still very positive, being led by strong momentum and low volatility. And that's important because actually this model did quite well last month in assessing that the pullback we witnessed, the model had signaled that it would be temporary, which is, of course, what we experienced. But our longer-term models, of course, remain positive on the US as well, albeit a little bit less so, given we got some soft labor market data in the interim. But overall, when you put the two models together, the case to remain overweight, still comes through quite strongly. Now, the other market where overweight, of course, is Japan. That's our second overweight. And this is the only major market where, admittedly, the short-term model is a little bit more bearish, correctly so. But when you look beyond that, that 1 to 3 month horizon, we still see this very much as an opportunity to accumulate, given our long-term view of improving growth and shareholder-friendly policies does seem to be panning out, and hence we sort of stay overweight the region and use this weakness to add. In Asia, a couple of different stories. So Indian equities is one market where overweight within Asia ex-Japan. We're, of course, getting closer to the end of parliamentary elections with the results due on the 4th of June. Now, expectations are for policy continuity, but history shows that markets do tend to trend positively into elections and react well to an expected outcome. So that's one overweight, together with South Korea, which, of course, is a cyclical market. The one that's perhaps where we get the most questions is China. We've had China's issuance of special ultra-long government bonds and, of course, the proposal to buy unsold real estate inventory. And we get asked a lot whether that signals a turning point in the market's outlook. Our view, of course, here is a little bit more balanced. We do think short-term market momentum remains quite strong, so we do think this gains we're witnessing at the moment can extend over the short horizon of about 1 to 3 months. But longer term, though, we see China as a core holding, and we just think the recent market measures aren't really sufficient for us to consider upgrading that.
What about the gold and the bond markets? Those rallied quite a bit in recent weeks. So should we also chase after it?
Well, gold indeed has run quite strongly, and when we try and look at the drivers of the rally, we think it's really coming from many factors. There's strong end user demand, we've got central bank demand, and of course, we finally got falling bond yields. But the one sort of note of caution is that investor positioning does look quite crowded. So while we revised our 3 month price expectation a little bit higher towards sort of $2,300, uh, we still believe a core allocation, which translates to about a 5% allocation across most risk profiles, still offers the best risk reward at current levels rather than blindly chasing from today's crowded positioning. Within bonds, our overweight, of course, on EM US dollar bonds, which have outperformed global bonds so far in Q2, and support here, of course, coming from the high yield on offer, as well as the asset class's high sensitivity to falling US bond yields. So these are factors which we believe will continue to offer support, hence we're retaining our overweight here.
Or can't end off without talking about our opportunistic ideas? Any changes in views over there?
Indeed, we must talk about the opportunistic part of portfolios as well. And we have a few changes here, specifically four. So, first, of course, we're adding a new buy idea on large cap Taiwan equities. We believe this market's significant exposure to semiconductors mean that it should benefit from demand for the most advanced chips from AI as well as non AI users. Second, of course, we're also adding a buy idea on China offshore US dollar bonds. So while we have seen riskier Asia dollar bonds rally, and credit spreads generally remain tight across corporate and EM bonds globally, we think China dollar bonds still offer some room for value and those spreads to tighten a little bit further, in our view. So that's the second area. Third, of course, we are closing our buy idea on the US energy sector. This is unfortunately at a small loss of about 2.2% since we started the idea in late March. But we do believe it makes sense because it helps trim energy exposure at a time when oil prices are coming off the boil. We are keeping, of course, our buy idea on European energy sector open, which, of course, faces the additional tailwinds of strong free cash flow and high dividend share buyback yields from more integrated oil companies. So we think closing the US idea while keeping the European idea brings a little bit more focus, but also keeps some degree of a hedge against the risk of any new oil price surges. Finally, we're also closing our buy idea on US inflation protected bonds as the inflation worries we discussed earlier start to recede. So although the idea is about flat to slightly lower since the 1st of February when we opened it, it has outperformed global bonds considerably, given just how inflation concerns escalated. So we think it's a good time potentially to close that.
Plenty of insights from Manpreet here. Thank you so much for that, Manpreet. To wrap it all up, the key pointers are: one, we see room for equity markets gain to extend as the cooling inflation brings the bond yields lower and sustain central bank rate cuts expectation for the rest of the year. And two is we maintain our preference for US and Japan equities and EM US dollar bonds. However, we are a bit reluctant to chase the goal higher given the crowded investor position. And lastly, for the opportunistic allocation, we add buy ideas on Taiwan equities and China US dollar bonds, and close our buy ideas on US energy sector equities and US inflation protected bonds. That's all for this week's podcast. If you'd like more details, do check out our latest global market outlook report titled A Macro Summer. Have a good weekend ahead. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.